Good morning and welcome to the Mint. Of course, you know, Monday is my favorite day, and you can't get your day started without watching the Mint. Now, some of our main stories today: African Continental Free Trade Agreement. How will it affect Zimbabwean business? And will Zimbabwe reduce the flow coming out of the Zambezi River in exchange for discounted power? All this and more on the Mint. Don't go away. We'll be right back. The market, and we start here at home on the Zimbabwe Stock Exchange. Now, really, over the last week, the Zimbabwe Stock Exchange has traded water after its gains and losses after SI 142. As you can see, on Friday, the Zimbabwe Stock Exchange all-share index closed down 0.28%, as did the industrial index as well. And top 10 were down 0.66%. Mining was flat. So really, you can see not a lot of movement happening there. And in fact, there's been this trend, I think, pretty much for the whole of last week. But now, if you look at some of the losers that are going on the marketplace, you see that the losers included Simbisa, Cassava, Smart Tech, First Mutual Holdings, EcoNet, and Pro Plastics. They were pretty much down. You can see First Mutual was down 8.13% on the day. And of course, if you look at the main gainers on the bourse, they were really Old Mutual. Old Mutual is still finding favor with investors. I'm not sure if this is a signal that investors think that Old Mutual share is undervalued, but we'll keep an eye on that. And of course, Seedco, Power Speed, Mashonaland Holdings all traded up in terms of what they're trading, and not so much. Mashonaland Holdings up plus 18.23%, quite a large hike for the day, and Seedco 6.63% up. Now then, that's really what's happening on the Zimbabwe Stock Exchange, but it's still a good place for investors to go have a look at, to at least look at investment. Remember, stock exchange is a place where people go to when there are economic turbulent times, and of course, with the gains in the stock market, it's huge gains. You should look at that in your investment portfolio. Now, crossing across to South Africa. Now, in the third State of the Union address, SONA, it's the second address in 2 years. In fact, President Cyril Ramaphosa said most South Africans believe the state should now focus on implementation rather than talk. South Africa's struggling economy must be a priority, he said, including a 50% youth unemployment rate, which he called a crisis. With 10 years to 2030, Ramaphosa said heroic effort needs to be made to achieve the goals set out by the National Development Plan, due to be achieved by then. He focused on 7 areas he identified as priorities over the next 5 years. These included economic transformation and job creation, education, skills and health, consolidating the social wage through reliable and quality basic services, spatial integration, human settlements and local government, social cohesion and safe communities, a capable, ethical and developmental state, and a better Africa and world. Then he also came up with 5 new goals that South Africa needs to achieve by 2030. These 5 are: no person in South Africa will go hungry, the economy will grow at a much faster rate than the population, 2 million more young people will be employed, schools will be have better educational outcomes, and every 10-year-old should be able to read. Violent crime will be halved or better. There's 2 other areas I'd like to focus on that he also came out in the State of the Nation address. Of course, there were loads of other issues, but the 2 I wanted to pick out were, one about the Reserve Bank. He said, South African Reserve Bank is a critical institution of our democracy, enjoying wide credibility and standing within the country and internationally. He confirmed the constitutional mandate of the Reserve Bank, which he said must be pursued independently without fear, favor or prejudice. And the second highlight I want to really show you is the private sector has committed 840 billion rand to create 155,000 jobs. Ramaphosa said, aside from the 300 billion rand in investments announced at the inaugural investment conference, the South African private sector is committed to a further 840 billion rand in 43 projects to create 150. The war of words continues between the U.S. and China over the trade war, with President Trump tweeting on Thursday that China was not living up to its promises it made in buying agricultural products from American farmers. His comments threatened to revive worries about trade, with the world's two largest economies still locked in a protracted dispute. Now, on the dollar front, investors are likely to closely monitor Producer Price Index, PPI, and Core PPI for June. At around, it was coming out on Friday. By the time of this program, we hadn't yet got the numbers, but we will give them to you tomorrow morning. And in corporate news, Infosys will release their latest quarterly earnings, in fact, late on Friday evening. Now then, European markets. Now, European stocks. European stocks traded higher on Friday as investors reacted to the new Chinese trade data. An official report Friday revealed that China's exports fell less than expected in June, with the dollar-denominated exports falling 1.3% from the same period a year ago. Economists polled by Reuters had expected a 2% decline on the back of the ongoing trade war with the United States. And looking at individual stocks, Daimler stock was down 3% in early deals, but recovered to trade around the flat line. The German car maker warned investors to expect a second quarter loss before interest and taxes of 1.6 billion euros after a 2.6 billion euro profit posted in the same period last year. The IMF, in the report published Thursday afternoon, the International Monetary Fund urged fresh stimulus from the European Central Bank to mitigate rising economic dangers, causing stocks to slide into the red. The IMF warned that the Eurozone economy faces risks from trade tensions, Brexit, and Italy. And, of course, again, individual stocks and corporate news. Chinese tourism group Fosun said on Friday that it is in advanced talks with Thomas Cook, leading banks, to inject £750 million into the London-listed travel operator. The British tour group stock plummeted on the news to its lowest level in record and was down more than 40%. Air China has agreed to buy 20 A350-900 jets from Airbus, bolstering the European plane maker's order book for wide-body aircraft against Boeing. And, of course, as you know, for the first time, Airbus has overtaken Boeing in terms of orders. So we're going to keep an eye on that as well. The aircraft war, if I can call it that, continues, coupled with the threats by the U.S. of putting additional tariffs on Europe because of what they call subsidies to Airbus. We're going to keep an eye on that. Italian infrastructure group Atlantia said it would explore the purchase of a stake in ailing national airline Alitalia, though it is unlikely to be ready ahead of the government's deadline of today. Norwegian financials company Storebrand fell 6.2% to the bottom of the stock 600 after a tepid second quarter results. Now then, let's have a look at Asian markets. Asian stocks mostly closed higher on Friday. Meanwhile, Chinese trade impasse with the U.S. declined in the first half of the year amid an impasse between two economic giants. Now then, data on Friday showed that China-dominated exports, as I said, fell 1.3% in June from a year ago, while imports fell 7.3%. And the stock market, as you can see, is opening today pretty much flat on Friday. In the first half of the year, Chinese total trade with the U.S. was down 9%, customs data showed. Gross domestic product in Singapore fell 3.4% in the April-June period as compared to the previous quarter on an annualized and seasonally adjusted basis. Now, the GDP, compared with a year ago, GDP grew 0.1% in the second quarter, the slowest year-on-year growth in the second quarter of 2019. That's in Singapore. Also less than the forecast of 1.1 expansion given by analysts. Despite the poorer-than-expected data, Singapore market recovered from the early dip, with the Straits Times index trading 0.1% higher by close of day. Let's have a quick look at African currencies. Now, looking at the US dollar slipped lower for the third consecutive day on Friday as stronger than expected US inflation data failed to shake convictions that the Federal Reserve Bank will start cutting interest rates at a policy meeting later this month. We keep telling you about that. Federal Reserve Bank is anticipated to cut interest rates by at least 25 basis points. The core U.S. Consumer Price Index, including food and energy, rose 0.3% in June, the largest increase since January 2018, data on Thursday showed. The reading pushed U.S. yields higher, but money markets still indicated one rate cut at the end of July and a cumulative 64 basis points in cuts by the end of 2019. So the markets are already factoring in their belief that the Federal Reserve Bank will cut interest rates at least by 25 basis points now in July, but a minimum of 64 basis points by the end of the year. The dollar's weakness revived carry trades. This is where hedge funds borrow in low-yielding currencies, such as the Swiss franc and the euro, to purchase higher-yielding ones, such as the Australian dollar or the New Zealand dollar. Now then, commodities around the world. Have a look at them. Now, having a look at gold. Now, gold rose on Friday and we're on track to post a weekly gain, consolidating above 1,400 as renewed Sino-U.S. trade tensions amid global growth jitters and prospects of an interest rate cut in the U.S. Now, remember, I keep telling you everything is connected. So there you have it. Interest rate cuts in the U.S., interest rate cuts possibly in Europe, as well as, of course, the tensions between the U.S. and China in their trade war, all affecting global markets, affecting gold, affecting metals, and, of course, affecting currencies. Meanwhile, U.S. President Donald Trump and China are not living up to promises. He said this, buying agricultural products from American farmers. The trade spat has spilled over to global markets and exacerbated economic jitters, and weak economic data from Singapore is also the latest trend of that in terms of how the economies around the world are suffering from the trade war. Now, adding to global uncertainties, Iran's alleged attempt to block a British-owned tanker heightened tensions in the Middle East in the wake of attacks on tankers and the downing of a U.S. drone by Iran in June. Gold is considered a safe haven investment during political and financial uncertainty, and sure enough, it is showing that, with gold still remaining firm as investors are not quite sure what's happening on economic fronts in their countries. So expect gold in the near term to stay firm until at least the U.S.-China trade war comes to at least some finality or an agreement is reached. Other precious metals, silver was up, platinum was also up, and palladium was also up. Now then, energy. Looking at oil. Oil neared the 6-week high on Friday and was on track for a weekly gain. U.S. oil producers in the Gulf of Mexico cut more than half their output because of a tropical storm and as tensions continue to simmer in the Middle East. By Friday, oil companies in the Gulf of Mexico had cut more than 1 million barrels per day of output, or 53% of the region's production, due to the tropical storm Barry, which could make landfall Saturday on the Louisiana coast. The storm was forecast to become a Category 1 hurricane with winds of at least 74 miles per hour. Iran on Friday called on Britain to immediately release an oil tanker that British Royal Marines had seized last week on suspicion it was breaking European sanctions by taking oil to Syria, a foreign ministry spokesman told state news agency IRNA. So, of course, oil is still suffering from the tensions, and, of course, as you know, the Americans did move troops to the Middle East in anticipation, quoting or citing an imminent attack from Iran. Iran, of course, said that was not true. Anyway, that's it for in the market. Now, in the economy, we're looking at, will Zimbabwe agree to reduce river flow from Zambezi at the request of Mozambique for reduced power? And the African Continental Free Trade Agreement. How will Zimbabwean companies benefit? Don't go away. All this and more on The Mint, coming up shortly. Welcome back to the Mint. And of course, we always start off with a little bit of an amusing story for you. Young, newly appointed IBM company's manager, he was in trouble because he did a deal and he lost $10 million. When he realized his mistake, of course, it was too late. The money was already gone. So when he came to the office the next day, he was feeling very guilty and he decided he would not wait to be caught, but he would go and tell his bosses what he had done. So he went into them and he said, look, I understand you want to, fire me, admitting my guilt, and I accept your decision. And the leader said to him, his boss said to him, retire you? He said, why would I do that? We've just spent $10 million training you. Why would we throw away such a valuable human resource? Go back to work. Now, I'm not saying you should lose $10 million, but hey, that's a good thing, and he'll work very hard for that company in future. Anyway, on a more serious note, state-owned mobile telecommunications company Net1 says it has managed to reduce its negative working capital as part of efforts to restructure its balance sheet. The company's chief executive, Lazarus Muchenje, said Net1, which recorded a $10.2 million profit for the year ended 31 December 2018, managed to make a massive turnaround from a $77 million loss position previously recorded at the close of 2017. The Mint reporter Indaka Majaka gives us more.
Mobile network operator Net1 says it has managed to cut its negative working capital to $59.4 million in the year to December 2018. This was up from a whopping $228.6 million recorded prior comparative period.
The year 2018 witnessed the resurgence of Net1 as the leading network of choice in Zimbabwe, with a historic $88 million turnaround from a loss situation of $77 million in 2017 to a profit of $10 million in 2018.
The group's revenue for the period grew 13% to $119.1 million from $105 million on the back of improved income from the data revenue stream.
I'm happy to report that we've narrowed our liquidity gap from a negative $229 million to only a negative $59 million. And we continue on this journey, and we hope that by the end of 2019, we will not have a negative liquidity gap on our balance sheet.
The telecoms operator's network availability is currently at 99%, up from 95% prior to 2018. Additionally, Net1 subscriber base has also improved, with subscribers going up 25% to 3.3 million from 2.6 million previously. For the Mint, I'm Indaka Majaka in Harare.
Sterling results coming there out of Net1, and of course they've been working hard to increase their profitability, make themselves more efficient, and make sure that they have a wider coverage around Zimbabwe. So we'll keep an eye on Net1 for you, because that's a company to watch, particularly if they are privatized as part of the finance minister's plan. Anyway, looking at Zimbabwe now, Bloomberg reports that Zimbabwe has proposed reducing the flow of the Zambezi River in exchange for receiving discounted power from neighboring Mozambique. People familiar with the situation said the proposal will result in the closing of Zimbabwe's Kariba South hydro plant, which would bolster critically low water levels in the world's biggest man-made reservoir, said Zimbabwean government officials and a senior manager at the state power utility, who asked not to be identified because the talks aren't public. This is obviously from Bloomberg. The plan would also limit the flow into the already full Cabora Bassa Dam in Mozambique, as water wouldn't need to be pushed through the plant's turbines, the people said. Opening the floodgates at Cabora Bassa could inundate the low-lying Zambezi Delta on Mozambique's coast. In return for limiting the river flow, Zimbabwe would want to be compensated with cheap power from Cabora Bassa, which has the capacity to generate 2,075 megawatts. Now, Kariba is 28.9% full, according to the Zimbabwe National Water Authority's website. Now, the power plant on the south bank of the dam, which straddles Zimbabwe and Zambia, is producing about a third of its 1,050 megawatt capacity. Zimbabweans are currently experiencing power cuts for as long as 18 hours a day, and I'm sure you all know that by now, because of aging equipment at its power plants, which includes thermal power stations. They keep breaking down, and of course the outstanding debts to utilities in South Africa and Mozambique. Talks between Zimbabwean President Edi Mnangagwa and his Mozambican counterpart Philippe Nyusi began in June, and Zimbabwean Energy Minister Fortune Chasi will travel to the Mozambican capital, Maputo, to complete the arrangement when it is ready, the people said. A board member at Hidroelétrica de Cobora Bassa SA, the company that operates the Mozambican plant, confirmed there had been an approach by Zimbabwe, declining to be identified as the matter hadn't yet been discussed publicly. The company, which is state-controlled, would be wary about lowering prices as it also sells electricity to South Africa, which might have similar demands, he said. The company isn't involved in active negotiations. Anyway, we'll keep an eye on that. As I said, it's a report from Bloomberg, and it's also sources that refuse to be identified. So we'll keep an eye on that and see if there's anything behind it. Now then, China. Tanzania's standard gauge railway project is set to receive funding from China. This is according to Foreign Affairs Minister Palamagamba Kabudi. Chinese Exim Bank proposal to fund the project was earlier rejected in favor of a Turkish-Portuguese consortium. After that deal failed, Tanzania declared it would pay for the project out of its own pocket. That had worked for the first two phases of the project, Dar es Salaam to Morogoro and Morogoro to Makutupora, covering 726 kilometers and costing $2.5 billion. The SGR, stretching 1,475 kilometers from Dar es Salaam to western Tanzania, is one of the mega infrastructure projects being touted by President John Magufuli's government as key to his industrialization agenda over the next decade. The budget for the railway is $7.5 billion with a 5-year completion timeline. Tanzania will be the third East African country to implement modern railway services after Kenya and Ethiopia, who constructed them with the help again of the Chinese. So it appears the Chinese are willing to come in and invest in infrastructure, particularly in West Africa. Now then, African Continental Free Trade Area. We've all heard about this in the recent past in the newspaper, particularly in the Herald. I've talked extensively about this, and of course the Business Weekly. A couple of days ago, the African Union officially launched the African Continental Free Trade Area. While countries still need to agree on plenty of details, it promises to become the world's biggest free trade area. 55 countries and more than 1 billion people will enjoy mostly tariff-free trade between countries. African countries have agreed to scrap tariffs on 90% of their imports from other African countries within 5 years. This will make it cheaper for the countries to buy from one another and will encourage trading on the continent. A couple of the poorest African countries, including Niger and Malawi, will get 10 or even 15 years to reduce their tariffs to give their producers some protection against cheaper imports. There are two possible implications, however, that people haven't focused on that will come with trade barriers coming down. First one is an African passport, and the second one, a digital African payment system. One of the ambitions of Africa is to make it easier for Africans to travel, work, and live anywhere on the continent. So who knows, maybe in the near future, we may have an African passport issued to all African countries who are part of Africa. Now then, African countries don't trade with each other. That is why Africa was so essential. In fact, if you look at the numbers, 2/3 of African countries' exports go to Europe. Only 17% of exports go to other African countries. That is a dismal number. And if you think about it, in European trade, for example, Europe trades 70% within the continent of Europe, while in Asia it's almost 60%. The far lower African number is due to many problems, including that of infrastructure, because infrastructure between countries is very poor. And many countries in Africa also produce the same products, often agricultural and other basic commodities. So they don't necessarily need their neighbors' exports. If they want machinery or more sophisticated products, they have to import them from overseas. Now, what's this likely impact on Zimbabwe? This is the key. Well, first of all, it should create new export markets for our products. That's number one. Because, of course, opening up all those 55 countries does allow us to access into countries that we haven't traditionally been trading with in the past. Manufacturers could also quickly expand outside their usual export markets, of course. That's another upside for this. You have your traditional export markets. It allows manufacturing companies in Zimbabwe to widen their export markets in Africa. And goods imported from other African African countries should be cheaper, given that this is expected to be mainly agricultural products, and it could pose a challenge to local producers. So I think it's a chicken and egg, if I can call it that, because obviously Africa has great potential for Zimbabwe exporters. However, we must also be careful about imports and that it doesn't destroy local production and our own local markets for our products. And when will the deal take effect? Well, countries still need to agree on which products and services will be tariff-free, as well as rules of origin. Also, the countries still need to agree on matters such as investment, competition, and intellectual property rights. There's a deadline of January next year to agree on which products will be tariff-free. Now then, Zimbabwe is set to achieve $34 billion worth of infrastructure development in the next decade, the African Development Bank has said. Speaking at the launch, AFDB's principal country economist, Mr. Walter Odero, said Zimbabwe had over the years been backpegged by challenges, among them lack of working capital, high cost of finance, and inadequate infrastructure. The report we are launching today, that was 2 days ago, confirms that the country needs $34 billion over the next decade to restore its road, rail, aviation, energy, ICT, water and sanitation infrastructure to proper working condition. Part of the $34 billion, water and sanitation will require $3.7 billion US, power $1.14 billion US, transport $28.56 billion US, and communications $412 million US dollars. Now then, the mentioned Daka Majaka caught up with Walter Odero, and this is what he had to say.
The report we have launched today is covering 4 sectors. We have transport, we have energy, we have water, we have ICT, and the findings will cover 10 years from 2020 to 2030. Our estimation is that we will need $34 billion US dollars, or depending on the exchange rate, about 280 billion Zimbabwe dollars over the next 10 years. Now, in terms of the distribution, bulk of that will go to the transport sector, where the roads sector actually will account for about 27 billion, and then the rest will go to the rest of the sectors. We expect the national budget to account for about 32%, and the rest of them will come from development partners, about 11% private sector, local authorities.
Of course, as much as we say $34 billion, the question is, where will the money come from? Well, AFDB has answers for that too. They believe that the private sector should provide US dollars 7.9 billion, government and local authorities 20.7 billion, donors 3.7 billion, and state enterprises involved in service provision in the sectors 1.5 billion. Now, the reason why this is important, of course, is that infrastructure is good for a country's economy. With a poor infrastructure, for example, freight is moved by rail. So therefore, that's why national rails of Zimbabwe are so important to be revitalized. You need to have a good road infrastructure to also move products and services from where they are grown or where they are made to markets. Also, of course, aviation. We need to increase not just our tourism sector, but also our freight sector in terms of getting our products to market quickly, particularly perishable goods. So this report was commissioned by the Zimbabwe government, and to find out what really was the latest requirements, money needs in terms of putting Zimbabwe back on a sound track. And that number is $34 billion US dollars. Now then, of course, a little bit of a smile to give you on Monday, because you know you're starting your week and you've got to start your week great. Monday's my favorite day, as everybody knows. So here we go. Now then, a bunch of grapes in Japan. It sold for $10,500 US dollars at an auction last Tuesday. But hey, it's not regular fruit. These were ruby Roman grapes, a variety of the fruit developed in 2008, according to NHK News. These grapes are roughly the size of a ping-pong ball and are known for being especially sweet and juicy with low acidity, according to Market Watch. Known for their distinct red color, the Ruby Roman Club calls it a dream grape. But listen to this. The bidder placed a record bid for $10,500 US. That boils down to $500 US per grape. Well, anyway, there you go. Some of the most expensive grapes in the world. But anyway, that's it for the Mint today. I, of course, will see you every weekday at 10 o'clock here on Zimpapers TV Network, ZTN. And please, your comments, keep them coming in on our Facebook page, Zimpapers TV Network. And, of course, please go to our website, ztn.co.zw, not only to watch the Mint, but other stories that ZTN is pushing out there. So, I will see you tomorrow. You have a fantastic day. I'm Andy Hodges. Take care of yourselves today.